Well, welcome. We have an exciting, a great panel today to talk about digital credit. Digital credit has been a hot topic, I would say, of this conversation or of this conference. Looking forward to discuss it. And to kick us off, why don't we start, Khing, start with introductions, and then we'll jump into the questions.
Hi, my name is Khing Oei. I'm the CEO and founder of Treasury. We're a Netherlands-based treasury company waiting for listing approval. And my own background is in credit. I was in distress and also started a CLO business.
Hi, I'm Siddarth Bharwani. I am part of Jetking Infotrade Limited, India's first and only Bitcoin treasury company. Started off last year and still a lot of space to grow.
Matt Cole, Chairman and CEO of Strive. I think we're the 14th largest Bitcoin treasury company of about 7,500 Bitcoin. We're the second one to launch a preferred equity, SEDA, which launched about a month ago.
So I think people are generally familiar with Bitcoin, being able to, the value of it in terms of holding it, selling it, and definitely understand the volatility. But there is less understanding about converted into income as through credit vehicles. And so when you think about digital credit in a Bitcoin world, how do you think about that? How do you define it?
I can kick it off. Yeah, for me, it's obviously the innovation that Saylor really created, which is re-securitizing Bitcoin, right? And it started with equitization, with taking Bitcoin in a public vehicle, making it available through listed equities. And then the next stage is creating credit instruments around it. And obviously started with loans, then converts, and ultimately pref securities. And each have their own pros and cons. Clearly, the benefit of pref securities is no maturity. They're perps effectively. And for me, what it means, it is that grander scheme of taking a digital gold, taking an asset which really increased in value over time. It has, and it will continue to do so, and offering different risk parameters against it, which is securitization. You take the equity, you take lower credit risk, higher credit risk against that, and that's really delivers a couple of things. One of the main things is that it offers different kind of investors access to Bitcoin exposure, which is also helping the ecosystem altogether.
For the India context, I think in India there's 90% of MSMEs in India do not have access to credit, for example, and just because of the way their credit structures are, I think the way we look at credit is slightly risk averse, and to build a Bitcoin credit system is potentially where you have to match it to how you use gold or look at gold in India. So I think once you map something similar to what gold does for you for credit, I think Bitcoin has a more real-time access in the Indian market.
Yeah, for me, the aha moment for digital credit was really foundational to why are we a Bitcoin treasury company? And we set Bitcoin as our hurdle rate. That how we think about ourselves as a business is that, yes, you can own Bitcoin and do nothing and collect a 30 to 50% CAGR a year. If you're doing anything beyond that, you should feel reasonably confident that over the long run, it will help your common equity actually outperform Bitcoin. And so you take this pristine asset, and in the common, you put more volatility, more Bitcoin risk volatility in it through amplification, and then you also create less volatility in a product in digital credit that provides income to people that maybe want or need a 10% yield. And how many investors want a 10 to 12% yield? I mean, so many people, and so many people that might not have wanted Bitcoin for any reason. And this is the power of securitization, that you can take an asset that has a ton of value and create different structures for different investors. And so a lot of Bitcoin bulls love amplified Bitcoin. That's what I want. I want amplified Bitcoin. I'm not really young, but young enough that that's what I would prefer for my portfolio. And then, people like, as an example, like my father-in-law, he wants digital credit because he's retired and he has an income, and that can, SEDA can provide a 12% income. That's a great product for him and many other people around the world.
So curious in what you are seeing is the biggest misconception about digital credit that you feel is standing in the way of its growth.
I can get off. Well, you look at how S&P has looked at the MicroStrategy products, right, as a rating, and they're not including Bitcoin on the asset side. They basically give no value to it, effectively, right? Which is why the strategy prefers to end up with a really low rating, much lower than you'd think. I mean, I'd much rather own one of those than any high yield bond that has a higher rating, actually. So I think that's one misconception on the value of Bitcoin and traditional finance not knowing how to really treat it in terms of asset coverage. I would say the second one is there's obviously been quite some sort of, I call it FUD, around strategy being able to pay its coupons, right? And if you think about it, strategy as a business model doesn't generate cash flow at the moment, and that's part of their sort of MO. That's how they operate. And for traditional finance to understand how they're going to be able to pay coupons is then a real big issue. Well, obviously there is a ton of options that the company has to pay those cash coupons, including issue new equity. And what I've done is probably smart to put a reserve aside and say, look, this is for the next 2 years at least. Let us figure out what to do else. So.
In our market, it's pretty straightforward. It's largely access to Bitcoin. I mean, there's just lack of information around what all you can do with this asset class, and there's not enough products. There's not enough companies talking about it. So I think straightforward, it's access to Bitcoin as an asset, and the other one is awareness in terms of how these instruments can be built on top of Bitcoin. And very few people are doing it at this stage in India, at least. And I think both of them are big opportunities for us.
Yeah, to me, by far, it's how do you pay the interest? And as I agree with both of the points that you made on the ratings, they're clearly underrated. The S&P methodology is flawed, and people easily understand that because they're not factoring in the Bitcoin. But what I think people don't understand is even just traditional funds. So my background, I used to work at a pension. CalPERS is the largest pension fund in America. And we ran perpetual leverage strategies. I actually ran them for CalPERS. And we had no cash flows. We were actually paying out more to pensioners than we were bringing in cash. So we were cash flow negative, yet we had perpetual leverage within the pension. How do we finance that? Because we had $500 billion of balance sheet assets. It was actually pretty simple. And you have a carry trade. So for a Bitcoin treasury company, you're underwriting that over the long run, Bitcoin will go up more than your financing cost. And if that plays out, the math just works on both sides. If it doesn't, you still have the balance sheet. Strategy has how many Bitcoin? 650,000. I think, I mean, for Strive, we have 7,000 Bitcoin. We have enough Bitcoin in current levels to cover our interest obligations for almost 40 years. Strategy, I think, because they have less leverage, it's 80 years or something like that. And I think people don't get that. And yes, we don't want to sell our Bitcoin. We're going to do everything we can to not. And like strategy, we have a cash reserve. We have over 12 months of cash reserve. Then you could consider things like yield strategies. Ultimately, you have Bitcoin as kind of the backup if you had to use some. And even if you had to use some, let's say in a downward scenario, it's probably something like 2% or 3% or 4% of the Bitcoin, not 50% of the Bitcoin. And so I think when people start to understand that, you say it's pretty hard, not impossible, but really hard to actually break these structures.
Now, each of you are operating in different markets. Would love to have you walk us through what are the products that you're offering and how are you structuring them?
Sure, I can get off. So yeah, we're in Europe. We're in Amsterdam. Euronext Amsterdam, one of the few in Europe on the main exchange, actually the only one. And in the European environment, it is a very fixed income heavy, fixed income friendly environment. Obviously, the whole mindset and the institutional investor base is very fixed income focused. So that in itself is a big opportunity set. Obviously, Strategy launched the first euro-denominated pref, which I think is great. It really opened up the market. And from there on, we're going to be tagging onto that. We are still awaiting our listing. We have obviously the term sheets ready on both converts and other instruments, which we'll be pursuing once we're fully listed.
For our market right now, there's straightforward just Bitcoin. There's no ETFs available. There's no digital credit available, and not enough institutions are talking about it. So ultimately, I think first you need maybe 100 listed companies to even issue equity first, and then build on top of that. So I think we're a long way from where the States is right now.
So our structure is intentionally very simple. We have one digital credit offering. It's preferred equity. It's SETA. And it's basically like Stretch from Strategy. We have a 12-month cash reserve. It'll be the most senior equity instrument ever in our capital structure, which is a little different than Stretch because there was already some higher capital structure ones within Strategy. And then we also have more amplification, and so more risk for a SETA investor than Stretch because we have more amplification. So we compensate for that with a higher yield. So our dividend yield's 12%, Stretch is 10.75%.
Now, when you look at the digital credit markets, how are you seeing and expecting things to unfold for digital credit to start to really compete with the current sort of structured finance offerings that are out there today?
So structured finance is a multi-trillion-dollar asset class, whatever you want to call it. I think your background's in that, my background's in that as well, right? Massive. And structured finance became a thing because you can take a asset that has value and create products that are distinctly designed for people. So I think with Bitcoin as collateral, the opportunities are near endless for Bitcoin Treasury companies, the preferred equity. I mean, I think that's going to be a massive market. That's going to be a global market that will also have differentiations. I mean, Strategy has 5 prefs now. They all have differentiations. They're moving into different markets. And we have one, but I think for other Bitcoin Treasury companies, they're going to find little differentiations that will actually appeal to different investors. So just like how if you look at like ETF space, like some people want an S&P 500 ETF. Some people want an ETF that also writes covered calls to provide income. Some people want a little bit of leverage. And so by differentiating amongst those products, find different investors that it uniquely appeals to. And then outside of Bitcoin Treasury companies, you have things like Bit Bonds, what Andrew Hones is trying to do, and really securitizing Bitcoin in the context of everyday investors. And so I think the opportunities to build this market out are endless, and we're really in. I mean, it's crazy, but Strategy's prefs are only 9 months old. It was like 9 months ago that they launched the first one. And so we're literally in inning 1 of doing this. And I think we'll find some things that work, some things that don't work, and grow this into hundreds of billions to $1 trillion industry.
For us, it would potentially be the regulators coming in first. That's the opportunity we have. In India, you have a dollar-backed jurisdiction, which is called the gift city. And there is potential for an outside-in move. There could be potentially companies offering in that jurisdiction. But again, like I mentioned earlier, it's a little far from home. Yeah.
Yeah, I think there are 2 main drivers, right? One is Bitcoin as an asset class and its size. So we're called $2 trillion now. I think all of us here in the room believe it can go a lot higher. Let's say it goes to $1 million, and we're talking about 20 trillion. And then, on the other hand, it's the adoption, because especially the credit markets are a bit more institutionally biased, right? Institutional investors need credit, they need fixed income securities to pay off liabilities, and if you increase that adoption amongst institutional investors by a couple of percentage points, then you multiply the 2, and we're talking about a massive market. And yeah, I agree with Matt. There will be different kind of instruments, different kind of flavors. Each of the Bitcoin Treasury companies will find its own way in that, and I think it will be very large. And obviously, that then helps overall adoption again.
And one more point that I was just thinking about is so our core business is an asset management business, and we have institutional finance backgrounds. And when you talk to an institutional investor, oftentimes in their investment policy statements, there's a requirement for 3-year track records, 5-year track records. And so for digital credit to go into many institutional investors that might be interested that have restrictions, this will be a 3, 5, 7-year build where things like a bear market in Bitcoin. I'm pretty optimistic on Bitcoin right now, but at some point it goes into a couple-year bear market. That'll actually be very important for digital credit to develop a track record of working through a downturn where interest payments are paid. And once you get through that and you've had a multi-year track record of paying dividends as an industry, you'll start to see more and more institutional adoption. But I think in crypto space, people can move at light speed. You come up with an idea, you finance it in a week. In institutional space, it works in years. And I think that's where we are. And, that's what Saylor's pioneering, doing, the world tour and telling every single person about this. I mean, he probably needs to sell 30, 40 billion dollars of digital credit just to get to the amplification level that he wants to do, right? This is a long-term strategy.
So speaking about the customers, who are buying your products, and how do you frame that and what they're looking for and what you anticipate building in the future?
Yeah, I think it's two ways, right? Institutional and it's retail investors. And each product has its own benefits. Certainly Stretch showed to be a very interesting product for both, but certainly retail investors more than the other instruments because it's like a money market account, which is with a very high yield. So in the European market, I certainly think there's a big opportunity set for that similar kind of short-term instrument with very high yields. And on the institutional side too, right? We have we're about 150 basis points tighter in Europe than in the US in base rates. So your bank account is low single digits. So there's a real benefit for both institutional and retail investors for higher yielding instruments, and that's really what we're offering with Bitcoin Treasury companies.
I think I'll echo to the same. I mean, your target audience remains the same globally, right? So in India also, there would be a potential of again, when you link it back to a gold bond, for example, you could have a Bitcoin bond as well. So once that does get built out, there could be a lot more institutional/retail adoption for that.
So as this grows, institutions have the mass amount of capital to kind of dominate on a percentage basis. But when we did the launch of SEDA, so it was we upsized to $200 million notional, and of that 200, it was near a four-way split. And the four-way split was you had your retail investors buying it through Fidelity, through their individual brokerage accounts. You had money managers, family offices that were buying it, financial advisors, they were about a quarter. You had fast money, so like hedge funds were about a quarter. And then you had long-term asset managers that were about a quarter. And so there was really a very equal split, but over time, as you're moving from the first several billion to the hundreds of billions, we develop track records like talked about, then I think that's where institutional starts to move up pretty heavily as a percentage of the market.
Now, Matt, you were referencing a little bit of the lead time that's going to be needed to penetrate into institutional, just having that track record. Does that mean that you're more bullish on retail in the interim in terms of those products and getting take up by sort of retail investors that are looking for that yield, especially if they're not able to purchase homes or invest in other assets?
Yeah, absolutely. And I think institutions want to see that too. And so when we first launched Stride, before we were a Bitcoin company, we're an asset management company. We have 13 ETFs, right? Like for the Bitcoin side, doesn't really matter to most people that are buying our stock today. But what was interesting is that we were launching an institutional asset management platform. But who bought our ETFs? We actually learned it was everyday Americans and independent financial advisors. Basically, people that could move fast without investment policy statements were the people that were the first movers. And then it shifts over time as you develop that track record. And so, yes, for us, I mean, it's really going out there and telling that story. I mean, you think about we have individual investors that just, high net worth people that put $10 million into SEDA, right? Like because they see that opportunity. And you don't need, for us, a lot of those to actually go, we raised 200 million notional. I mean, you can get there pretty quickly with that kind of support.
I was going to say, yeah, it usually, again, I ran my own hedge fund for a while, and the first tickets are always family offices, high net worth individuals who can move quick, right? As Matt said, institutions are excruciatingly slow because it's very asymmetric, right? As people used to say, you never get fired for owning IBM, right? It's the same thing. People are always in the institutional space more careful with new technologies, new assets, new products, etc. So as you get that track record, then it starts happening. So the first source is very much on that side, yeah.
Siddarth, anything to add from your perspective?
No, I think it's difficult to say right now as it unfolds, right? So at this stage, when we do open up the institutional capital, I think that there will be a lot of interest in the product like this, but tough to say right now at the position that we're in, right?
So What do you see as the key headwinds and sort of friction points to help, or that are in the way of digital credit growing and getting more of a foothold in your market?
Yeah, one thing is obviously the general market environment, right? We've seen a bit of decompression in that space broadly, also in Bitcoin Treasury companies. And this turns out to be fairly high beta with Bitcoin itself. So I think one tailwind would really be Bitcoin, going back to previous levels and higher. Hopefully, that's obviously going to be very helpful. I think in terms of and then the innovation will come that and issuance. In terms of sort of tailwinds, I mean, one is still in Europe. We're talking about a more an evolving regulatory environment. European regulators are very much, especially in the last 12 months, have become really much more removed from the US approach to digital currencies and also therefore digital credit, which is still very small in Europe. And then, as mentioned earlier, right, on the investor side, you need that to filter through. But also many institutional investors are looking at the regulatory environment as well. So I would say specifically for Europe, one of the still called headwinds that we're waiting to loosen up is regulatory environment.
I think the asset itself, right? Bitcoin as an asset in India has to be recognized completely and maturely. Today, there's a lot of gray area around how it should be treated, how it should be taxed, what are the products that you can build on it, how can you issue equity on it. So I think that becomes the biggest challenge. Till the time it's not mature enough, there won't be too much regulation around it. So we're waiting for understanding how that unfolds.
I think the headwind is just understanding what the risk and the potential return of the product, and the opportunity is that those that see this opportunity now can invest at higher yields. That over time, as these products develop track records through different market cycles, like again, we're 9 months into this, yields will likely come down, and that's when institutional capital comes in. But they're fine with that. They're fine with a lower yield with something that is more proven, and so that is the biggest headwind. Is you have a lot of supply that would like to come out here, obviously with Strategy being the leader of someone that wants to bring supply into the market, and going out there and educating. And I just say, like when you go out there and you have these conversations with people, I mean, I'm sure Saylor has 100x more of these than me, but you see it click with people, and they're like, I want a ton of this, right? Like, you're telling me you can pay me 10 to 15% yield forever, backed by Bitcoin, which I like. Like, and for at least in the U.S., it's a return of capital dividends, which means that you don't have to pay a tax on the income. It's like there's like I want to fill my portfolio with these things, but it takes time to understand this, and so I think that's the headwind. But I think it's been a banner year to get these out there, and ultimately I think they're just going to grow massively.
So, Matt, I want to come back to you with a current topic, and that is sort of the policy that MSCI has implemented to exclude companies that have more than 50% of the digital assets on their balance sheet. How do you look at that decision and its potential implications for the industry?
Yeah, so it's not decided yet, although maybe it is behind closed doors, but at least publicly what we know, there's a proposal there. So a long form letter. Actually, our ETFs own MSCI, so as a shareholder of MSCI, our customers are, and so we took the approach to say we're going to write them as a shareholder, a long form letter. And I think that there's a couple misinterpretations. One, that Bitcoin Treasury companies are investment funds versus actual operating companies. And so we really went deep into why these companies have products, that digital credit is actually a product being brought to the market. And then we brought in all the different ways that you could get around, all the loopholes you could get around it. It's just like not even a workable solution. And then lastly, yeah, so when I was at CalPERS, we used MSCI indexes. So, I've worked with them in the past, and investors not wanting something in their portfolio is extremely common. And we can debate the merits of that. And obviously in this conference, all of us probably agree that Bitcoin treasury companies should be in the indexes, that it's a positive thing. But if someone takes the other side of that, you can create a custom index. You could just say, MSCI, make me an index that has no exposure to Bitcoin or no exposure to DATs. I like Bitcoin treasury companies, but DATs, or name your thing, and we could debate the merits of any of those things. But for a core index, it should provide broad market exposure. There shouldn't be exclusions that make it more of an actively managed index, and that is what the MSCI decision would do. I think if there's a positive for it for Bitcoin treasury companies, I think that the market has already priced that in for strategies. So I think if it didn't get implemented, you probably see a nice upside surprise in the near term, and if it does, it's probably priced in.
Well, to close out the panel, would love to hear what each of you are excited about in terms of digital credit products moving into 2026. What do you expect to see come out, and where do you see the industry heading?
Yeah, I think the beauty of our industry is the constant innovation and the speed. And as Matt said, we've been in 9 months into digital credits, and it already seems like it's an aging industry. But I think for next year, we'll see more of that, right? We'll see new instruments, we'll see new issuers, we'll see new tweaks, we'll see the investors develop, and that's super exciting. So yeah, from here to the moon on digital credit.
For us, there's clarity, right? Regulatory clarity, and instead of a reactive approach to how companies or exchanges or any other institutions create products, there's a reaction generally. I think a more proactive approach to understand the technology and the asset. I think that's one of the biggest things that India needs right now.
I'm really excited to see it grow globally, to see different Bitcoin treasury companies internationally get these through their regulatory bodies. I mean, I know it's been probably a headache and a half for Metaplanet to get it out there, and I'm sure that every other area around the globe has their own unique things that are going to require strange, probably tweaks in the products to actually get them through the maze of different regulatory bodies. But I think the room for innovation is near endless.
Well, it's fantastic. Well, gentlemen, thank you for sharing your insights and your expertise. Hope you've enjoyed the panel. Please help me thank the panelists and enjoy the rest of the show.
Thank you.
Thank you.